This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Welcome to episode 16 of Value Investing. In this episode, I'll continue to talk about how you can derive an intrinsic value of a company. In the last episode, we talked about three different valuation approaches. First, ratio-based approach. Second, asset-based approach. And finally, acquisition valuation approach. And as I promised in the last episode, I'll talk about discounted cash flow approach, which is also very, very important one. And what I'm going to do in this episode, I'm going to quickly recap three valuation approaches that we discussed in the last episode. And I'll go right into the details of how you can derive company's intrinsic value by using discounted cash flow approach. I think it's going to be a very interesting discussion. And before I start, if you haven't already done so, please subscribe to my channel. And 5-star review always goes a long way wherever you listen to this podcast. Without any delay, let's get started. Let's quickly recap why intrinsic value calculation is very important for a value investor, and also three different approaches that we discussed in the last episode. The reason why it is so important for you to understand intrinsic value approaches is because you have to first value the business. I think that's really obvious, but a lot of people do not implement this step before they making huge investments. So whenever you are interested in a company for your investment portfolio, what you need to do first is try to understand what is the real value of the company. That's called intrinsic value of the company. And there are just many different ways you can do it. If you want to buy a bond, it's very simple. There's a well-defined approach you can use in order to value the bond. But when it comes to investing in stocks, people have different approaches, and I discussed already three different approaches in the previous episode. So there's just a lot of variations in terms of what approach you can use for intrinsic value. However, it doesn't mean that it is useless. For example, you can derive an intrinsic value of the company in a range. It is not precise number, but you can derive intrinsic value using different assumptions, using different valuation approach in a range. And once you establish this range, you can compare the current market value of the company to the intrinsic value range. And if the current market value is below the most conservative intrinsic valuation that you derive, then that means the current market value of the stock is likely to be undervalued compared to the real business value of the company. So that's why it's important for you to understand different valuation approaches, and important for you to derive intrinsic value in a range instead of getting to precise number. And that's also what Warren Buffett mentioned in his annual letter when he said that precise value is not going to help you, but it should be a range of value when it comes to calculating intrinsic value. Now, let's quickly recap what we have discussed last time. First, we discussed ratio-based approach. I emphasized two important ratios. One, price to earning ratio. The other one, price to cash flow ratio. I'm not going to repeat everything, but I'm saying that this is a good starting point for you to navigate various investments in order to identify undervalued securities. Second, I discussed also how you can use balance sheet in order to uncover asset value of the firm. In many cases on the balance sheet, you'll see original cost of fixed assets, for example, building or real estate, lands that company owns. they may not be truly reflective of the current value of those assets. So if you can find and uncover hidden asset value on the balance sheet, you'll likely to find undervalued securities in the market. Finally, I discussed how acquisition valuation can be used as an add-on on top of other valuation, because this is a positive surprise that you could have in the future if a big company acquires a small company that you have already owned in your portfolio. And there are various reasons why big companies are acquiring small companies in their industry, but if the small company has unique products or unique technology that big companies want, then it can definitely attract a lot of acquisition potential deals in the future from big companies. So these are the three main approaches that we discussed in the last episode. What I want to do in this episode is get into the details of discounted cash flow approach. The discounted cash flow approach is the one that Warren Buffett uses in order to evaluate an intrinsic value of the company. Warren Buffett has frequently mentioned the importance of using discounted cash flow approach, but he never uses computer, he never uses Excel. Everything is done in his head. He may have different time periods when it comes to doing this analysis and so on and so forth, but there are three main questions that you need to answer when it comes to discounted cash flow analysis. And that's what Warren Buffett mentioned in his letter. The first question you need to ask is, how certain are you about the future cash flows? Depending on the company that you're interested in, you may be able to estimate future cash flows in a relatively certain way, or your cash flow estimates might be very uncertain given the current situation of the business. For example, if you're trying to invest in a pharmaceutical company that has a lot of products in the pipeline that are not out in the market yet, but this pharmaceutical company is waiting for the regulators to approve some of their products in the pipeline, then your future cash flows will be very uncertain depending on whether the regulators would approve products in the pipeline. Future cash flows can really spike up or can go down significantly. So in this case, you're not certain about the future cash flow. Whereas if you look at other industries or other companies, for example, Coca-Cola, you'll see that in the past, people have consumed Coca-Cola on a daily basis. That's what's happening today, and that's what will happen in the future. So cash flows from companies like Coca-Cola will be very stable, and you should be able to estimate cash flow in a relatively stable manner. So certainty definitely matters when it comes to estimating future cash flow. And Warren Buffett usually likes to invest in a company that has demonstrated stable earnings in the past, and that's what he put in his one of the acquisition criteria for his investment. But if you for some reason have some ability to estimate future cash flow in a certain way, then it's going to give you a huge edge over other investors. For example, you can be in pharmaceutical company and you know how regulation works, and you know what kind of things that regulators look for when it comes to approving pharmaceutical products, then it's going to give you a huge advantage over other investors as far as estimating cash flow is concerned in the future. The second question that you need to ask to yourself when it comes to estimating intrinsic value using discounted cash flow is that, when will the cash flows emerge and how much will there be? So this question is related to the first question. The first question about the certainty of cash flows, and the second question is about how much this cash flow will be and what is the timing of the cash flows. It is also not easy question to answer, because even if you ask the management team wouldn't be able to answer how much revenue and cash flow they're going to generate. Maybe next year, probably they can estimate with some certainty, but if you ask management team about 5 years down the road, they might not be able to answer with confidence. As an investor, it is very difficult job for you to do. So that's why I said in the last episode, the valuation is more art than science, because it is very challenging for you to estimate future cash flows if it's more than 5 years. Let me tell you what a lot of people and professional investors do when it comes to using discounted cash flow model. They have multiple stages of cash flow estimate, and at the end, they calculate terminal value. I think that's what you can do, but my recommendation is just stick with 2-stage model and don't go beyond more than 2 stages. So let me try to explain how this 2-stage model works. The first thing that you have to do is calculate the first cash flow. The first cash flow is important because it is the base that you start from. You look at previous cash flow and see how you can derive normalized cash flow that takes into account business cycles and excludes unexpected items in the financial statement. So once you have this first cash flow number, the next thing that you have to do is to estimate growth rate of this cash flow for the first time period and the terminal time period. The first stage is about growth period, where the firm can grow more than GDP growth for United States. So you can say 7% or 6%, depending on how conservative you are in terms of cash flow projection. And the second stage is terminal value calculation. So what you're trying to do is the company has become mature and company is going to grow in line with GDP growth, which is about 2.2% to 3%. So you can use that growth percentage for your terminal value calculation. It's important for you to bake in conservatism into cash flow projection. And if you're not certain, the first question about cash flow projection was certainty of cash flow. And if you are not certain about future cash flow estimate that you're deriving and using for the model, then you have to use lower number. So for example, let's say your cash flow projection for the first year is 100 million, second year is 100 million, all the way to 5 year 100 million. And if you're not sure and uncertain about this cash flow, you can simply use some haircut, like 30%, 40% haircut, depending on how conservative you are in terms of cash flow projection. So here again, it's more art than science, because nobody knows how much cash flow the company is going to generate in the future. You so have to use some ballpark estimate when it comes to estimating future cash flow, and also apply some haircuts depending on how certain you are. What Warren Buffett uses is he usually invests his money in a company that has demonstrated stable earning power. So he's in some sense quite certain about future cash flow. So he puts his numbers into this cash flow projection calculation and does all of his calculation in a normal way, and he only buys investment when he sees a huge margin of safety later on. I'm going to discuss about that more detail at the end of this episode. But my recommendation is to put cash flow in a conservative manner so that you don't overvalue the company. The last question that you need to answer is, what discount rate should I use? Here again, there are a lot of opinions from academia, from Warren Buffett, from different legendary investors about what discount rate you should use. If you look at Warren Buffett's comments in the past and his annual letter, Warren Buffett uses a 30-year treasury bond as his discount rate. The reason why he uses U.S. Treasury bond, a 30-year Treasury bond, is because that's the time horizon that he's thinking about when it comes to investing his money in the stock market, right? 30-year long term. And also, he's going to look at what is the next best investment if I don't invest money here in this stock. So Treasury bond is good alternative, and it can come as an opportunity cost if you invest this money. So if you don't invest this money, you can always invest in Treasury and get, let's say, 4% from there. And this is the opportunity cost. You can easily invest with 100% certainty. The government, US government, is going to pay you 100%. Let's say US Treasury bond is producing 4%, and if your investment expected return is less than 4%, it's no-brainer. You shouldn't invest in that security. So that's why it is the minimum required level of return for Warren Buffett to use. But also it's quite low compared to what other professional investors are using, because if you have attended MBA classes before, then you probably learned something called WACC. WACC stands for Weighted Average Cost of Capital. The way you calculate WACC is by taking risk-free rate of return, which is a 30-year US Treasury bond, and plus risk premium. So if you calculate your discount rate using WACC, then it's likely that your intrinsic value is going to be smaller than just using US Treasury bill. But here, then you might have one question, because you think that Warren Buffett is a value investor. He only buys securities when intrinsic value is a lot higher than the price of the stock. But the way Warren Buffett calculates intrinsic value is higher than other professional investors do. Then you might be scratching your head why Warren Buffett does that. So there are 3 different ways you can bake in your conservatism when it comes to calculating intrinsic value and buying and investing your money in the stock market. The first way is, as I mentioned, you can bake conservatism into your calculation by applying some haircut to your cash flow. That's number 1. Number 2, you can increase your discount rate that you use for your discounted cash flow analysis. Warren Buffett here doesn't do that. Warren Buffett also doesn't do haircut for cash flow approach. What Warren Buffett does, in order to be conservative, he applies a huge margin of safety. He only invests his money when the margin of safety, which represents the gap between intrinsic value he derives and the price of the stock, when this margin of safety is big enough, he invests his money. Otherwise, he doesn't invest his money. So there are 3 different ways that you can bake conservatism into your calculation. Number 1, cash flow that you estimate. Number 2, a discount rate. Number 3, margin of safety at the end. whatever works for you, I think you can use it. But if you derive your intrinsic value in a conservative way, whichever way you use, if the current price of the stock is lower than your conservative valuation, then you can fairly say with some certainty that the stock is undervalued. So let's try to summarize what we have discussed so far and how you can apply this discounted cash flow analysis for your investment decision. First thing, as I mentioned, you need to do is to estimate the first year cash flow. And you can do that by looking at past cash flow in the business. And these numbers are all publicly available in the financial statement. You might have to make some adjustments in order to find out normalized cash flow that excludes all unexpected items. And that's the first step. The second step is to estimate growth rate for the first stage. And here again, you can be more conservative and say that zero growth percentage. For example, first year cash flow can be 100 million, second year 100 million, all the way to fifth year 100 million. Or you can bake in 7% or 8% growth rate based on your best estimate of the business. And this is the first stage of your cash flow estimate. And you have to determine how far you want to go. But my recommendation is to not go beyond 5 years. So you can make it 3 year, 5 year, and you can be more creative at this point. Once you have this first stage cash flow, the second stage cash flow is you have to derive terminal value. For this terminal value, let's say you determine 5 year cash flow as your first stage, and your sixth stage cash flow, let's say it's 100 million, and you have to take that cash flow and divide it by required rate minus growth rate. For required rate, we can use discount rate we're going to talk about in a second. And for growth rate, you can use US GDP rate of growth. Because here the assumption is that the company cannot forever grow more than GDP rate. Otherwise, the company is going to be bigger than US economy at some point in the future, which doesn't make sense. So you can apply this different growth rate and also calculate terminal value. So once you do that, you have to discount all this cash flow, 5 year cash flow, and terminal value back to present value. The way you can do it is either you use Warren Buffett's approach, which is using US Treasury bond rate, let's say 4%, or you can just add risk premium. And finally, once you derived a range of intrinsic value, you can compare that against the current market price and see where the current market price is a lot lower than intrinsic value that you assessed. If it is the case, and if business is in good shape and has good business models and good management team, that's when you can jump in and make big investment for your investment portfolio. One last thing that I want to mention in this podcast episode is that you can find a lot of tools online in order to calculate discounted cash flow. You can simply Google discounted cash flow calculator. You'll find a bunch of tools available online. What I usually use is I go to growthfocus.com, and this is a good website for companies' data analysis. And I simply go to discounted cash flow section of Growth Focus. And the good thing about this website is that website provides earning per share upfront as your baseline, and you can use that, or you can convert that to free cash flow per share and apply this two-stage model. And you can change your assumption about first 5 year growth rate or terminal value and things like that, and can derive a range of intrinsic value in a very, very fast manner. I'm not affiliated in any way with this GuruFocus.com website, but I just found it easy for me to do this intrinsic value calculation. And you don't have to pay any money. For certain features, you have to subscribe to this website as a member, but you can just sign up to this website and you can use free service. And one of the free services they provide is to calculating intrinsic value using discounted cash flow analysis. Okay, so that's it for this podcast episode. I know that we have discussed a lot of technical things in this episode. So what I'm gonna do is I'm gonna put the details of our discussion in the description box so that you can review what we have discussed and see if you can use discounted cash flow analysis for your intrinsic value calculation. Before I end, if you haven't already done so, please subscribe to my channel, and 5-star review always goes a long way. And if you want to leave any comments or feedback, please do so on valueinvesting.blueberry.net. Thank you very much and see you next time.